Welcome back to Wall Street Week. We're chatting with Liz Ann Sonders and Kevin Kelly. And during the commercial break, we're sitting here debating politics. So, Kevin, we talked about it in the A block. There's this notion out there, and we've had a number of guests come on, and they say Hillary Clinton will be good for the stock market because they know what to expect. But there's also some strategy out there that says that when you have one party, both in the White House and in Congress, that actually markets do better. Your thoughts on this are what?
Yeah, gridlock is not good, especially for the markets, because there's a lot of uncertainty and a lot of policies can't be affected. We're in a ever-evolving, fast-moving global market environment. We're seeing policies change fast globally, and we're not able to react, and we're kind of going slow through gridlock. And you look at the historical returns, you really need unification throughout the government. You need all branches working together, and so the market will want to see an effective government that can actually adapt to these changes.
So, Anthony, this is data compiled by S&P Capital IQ, and they have shown that the stock market does better when you have one party in control. Why is candidate Trump not focusing on that?
I don't really understand the question, because I do think he's focusing on it.
I don't hear that message.
He's out there raising money for the Republican National Committee, which is building a ground game for the Senate and the House races, and so I do think he's focusing on it. So one of the problems that candidate Trump is having is that there's a media distortion prism. So every time he says something, they're doing the best that they can. Even the New York Times has come out and said, listen, we've dropped our objectivity on this thing. We want to go after this guy viciously. And so one of the things that have happened as a result of the campaign is that we've now exposed some of the mainstream media for what they really are, which is a lack of objectivity, and it's a huge bias, and I think the American people are onto it. But let me ask Liz a question, because it's market-related.
Yes.
In the event that there is a Republican president and a democratically controlled Senate, or vice versa, what do you think happens here in terms of the ability to get a budget deal done, infrastructure spending, the types of things that Dr. Ben Bernanke or Janet Yellen would like to see from the government in terms of helping to create growth in the economy?
So in theory, that would be a great thing. And I think when people think about a divided government and they look back in history and they see it as having been a good thing both for the economy and the market, I think you have to go back to eras like Reagan O'Neill and Clinton Gingrich, where there actually was that cooperation across the aisle. You got things done. You got opinions and voices from both sides. The problem is we're so polarized right now that even in a practical situation where you have one party in the White House and another party either in one or both houses of Congress, I'm not sure the political landscape is such that you're going to get the kind of cooperation that leads to an 80s or 1990s type environment that you had when there was that willingness to sit down and hash things out. And that's my frustration.
Yeah, and I think the important thing that investors need to take away is we do want a unified government to enact fiscal policies. We're seeing a lot of the monetary policies right now have run their course. They're losing their efficacy. And we're even seeing that from a lot of the federal governors talk about that. They're saying, hey, we actually need fiscal policies. So investors would cheer that. And one of the ways to enact those fiscal policies that we talked about, especially lowering the corporate tax rate, think about this. Over in the UK, they just had a referendum, but guess what they're doing? They're lowering their tax rate to 17%, and then by 2020, they're hoping to lower it to 15%. That's going to be great for business and their economy.
Let's just wrap up the market and the election. Both of you agree that whoever wins in November, that the market fundamentals are going to drive what happens to the S&P over the next year, or are we going to have some impact from the election?
I think there is going to be an impact from the election, especially initially, because people are going to try to figure out, are we going to have more of the same from the last 4 and 8 years, or is there going to be a change? And how are we going to invest in that type of environment? We actually saw recently from a Fed survey showing that 20% of corporate executives are actually going to do job cuts because of certain regulations for the Affordable Care Act.
Keep in mind, too, that in an 8-year cycle, which we have now, where we had the outgoing president having been in for 2 terms, if you look at every 8-year cycle, year 8 is the worst for the market. So in a normal environment, and in a year like this where you have no incumbent and you've ostensibly got 2 unknown candidates, you could argue that's not the case this time, at least with one of them, that's always been a volatility factor for the market, and I don't think it's any different this time.
Oh, listen, I'm super worried about the interest rate cycle. My guess is that we're growing fast enough now, and there's enough inflation that they'll start moving. And when they start moving, if there's no other angle here, like fiscal stimulus or some type of infrastructure, I do think the market will roll over. What's your opinion of that?
You know what? I can't help but being sympathetic to the camp, albeit small, that thinks that maybe at this stage in the game that the excess ease and liquidity of U.S. monetary policy has been a deterrent to economic growth, not a benefit to economic growth. It's the counterfactual, because we can't go back and say, well, if the Fed hadn't done as much as they've done, if they started raising rates a couple of years ago, maybe we'd be in better shape. But I think the confidence channel, the fact that we have a central bank treating the economic patient like it's still in the trauma room, I'm not so sure that that's been the kind of boost. I think we're seeing it globally, too. I think negative interest rates has been having the opposite effect.
But Dr. Bernanke and Chairman Yellen privately have said that they really needed help from the Congress and from the executive branch, and they don't feel that they've gotten anything.
Correct.
So that's why we've got the patient still on the gurney.
You do need another lever, and if you look at the Fed's balance sheet, it still has $4 trillion on it. And to Liz's point, she brought up a great point. We're seeing globally it's not working in Japan, it's not working over in Europe, so we do need new policies, and they can't really be monetary policies. And one of the biggest concerns we have is that in 2018, the average baby boomer is turning 65. We have about $55 trillion in unfunded liabilities hitting the balance sheet. So we have a lot of important things that this government needs to figure out, and they need to figure it out.
So, well, let me tell you this. I was at a bank yesterday with my wife, and all I can tell you is that there are millions of people in this country that hope that you are right, that if interest rates are going to start to have a real cycle of tightening here and go up, you've got millions of people that follow the rules, and they should be retired, and they should be living off a fixed income. They shouldn't have to put money into the stock market. And those people have been punished for the last 8 years because they followed the rules and they have not been able to get any kind of normal fixed income.
And they're showing up disaffected in the polling booths.
Absolutely, absolutely.
And there's in the aggregate, there's more money in the economic system that earns interest income than there is that pays interest expense. Yep. So I just don't see another 25 basis point increase as economic Armageddon.
And the scary thing is the market is telling you, because when because S&P 500 is yielding more than the 10-year Treasury, and the fixed income markets is telling you there's some worries on the horizon.
Yep.
If you had Gary's bank account, you wouldn't have to worry.
Here we go.
Our thanks to Liz Ann Sonders and Kevin Kelly.